Hello, everyone. I welcome you all to the latest edition of Corporate India webinars, a quarterly tradition where we discuss the insights and more about the results of the latest quarter. Thank you for joining us today, especially on a Saturday morning. Today's webinar will be headed by Mr. Balaji GR, Head of Research and Co-Fund Manager at ithought. So as usual, let us start with a very interesting data point. Out of 4,754 stocks listed in the BSE exchange, BSE 500 stocks capture 90% of the market value, clearly reflecting the importance of this 500 stocks. If you're bullish on India and want to capture the India growth from $3.5 trillion to a $10 trillion economy in this decade, well, this is the right time, and I'm sure this webinar will be an eye-opener to all. Um, Towards the end of the presentation, when we start the Q&A session, the attendees will be given access to mic as well as video. So without any further delay, let me pass on the podium to Balaji. Thank you, sir.
Hey, thanks, Tarun. Thanks, everyone, for joining. Tarun, can you just confirm the 1 second?
Sure, sir.
Hey, sorry, I think some issue.
It's all right, sir.
Screen is on?
No, sir, it went off. I can't see your screen.
Still now?
Now, yes, sir. Now it's visible.
Okay. Thanks all for joining. I think sorry for the glitch. I think having seen the disclaimer, right? The whole idea about talking about corporate India is every 90 days, we end up tracking close to 1,000 odd companies. As Tarun said, BSE 500 is a pretty very good universe to see what's happening in corporate India. And I think it's been our ritual. Every quarter end, we end up presenting what are the mega trends we are capturing out of corporate India, what's the corporate commentary, how the numbers are there. Because if you are a long-term investor, the most primary driver of value in the medium term will be the corporate India performance, and which we will share. And finally, what is our outlook on particular sectors and so on and so forth. And then we'll open the Q&A. So the broad topics we will cover in this entire session is first, the mega trends, which is guiding the entire force of corporate India. Second, how the commentary of being corporate India, both on economy, rural economy, Red Sea crisis, exports. So a couple of anecdotal evidence from corporate con call we will share with you. Third, we will talk about the numbers. As I told, it's very, very important to see the number from different dimension of sales, profit, large cap, mid cap, Nifty and non-Nifty companies. And finally, the outlook and the way forward. The mega trend, right? As we told, the biggest mega trend of our investing is India, right? If you just think about India as a stock, the entire economy is growing at a 10% CAGR for last 23-year period, right? A very phenomenal growth. So this 10% growth is a very important division when we look at corporate performance about corporate, which is growing above India GDP, or corporate growing below India GDP. Because if you talk to every company, they say they are a growth company. But when you look at numbers, right? Clearly, if someone is growing at 5, 6% over a long period of time and continue to communicate as a growth stock, right? The difference is for them, they could be still believe as a growth stock. But if you look at a country like in India, which is a growth economy, the country itself is growing at 10%. So it's very, very important when we build portfolio, when we look at companies, can these companies can grow 10, 15, 20% growth, not for 1 year, 2 year, over next 5, 10, 20 years, right? That is where the biggest value can be captured. And if you look at India, right, we were a 38 lakh crore economy 20 years back, then moved to 87 lakh crore economy. And as per FY 24-25, based on interim budget, we'll be like close to 325 lakh crore economy. So as an investor, right, the trend is very clear in our favor. So that is the biggest positive if you are coming with a 4 to 5 year outlook. The biggest thing which we should see is when does this 327 will become a 1,000 lakh crore economy, right? So that every conversation of us should see directionally where are we heading towards this 4 digit economy size, and how do we capture the best of economic growth from an I thought investors perspective. So having seen the India growth, if you look at the long-term picture of corporate India, right? So one of the very interesting thing which we continue to share to our investors is it's not only country is growing at a very healthy rate, the corporate India, which is Nifty earnings, is a very good benchmark of corporate India, is continued to grow between 12 to 13% in last 20 years. And even if you look at Nifty value, which is the index value, also grown at 13%. So you have three numbers: India growing at 10% roughly, corporate performance, which is earnings, growing at 12 to 13, and index is growing at 12 to 13. So these are the three numbers I think you should keep it when in the end I will share about what to expect from India in the medium term from a return point of view. Having seen both India GDP and the Nifty earnings, as Tarun told, right, the relevance of BSE 500, why we would like to talk on BSE 500 in depth, try to understand the universe better. Can we figure out some great ideas, great sector to invest in? The entire BSE universe has more than 4,000 odd stocks. The value is 393 lakh crores, right? Pretty large, close to 1.25 times of India GDP. But if you look at BSE 500, right, it captures 90 to 91% of the entire universe. So even though it's a very small subsegment of the entire listed universe, this segment constitutes predominant market value, right? So that is why it's even more important from a shareholder point of view, from an allocator point of view, how well this universe is doing, because this is what will drive the market in the medium term. The fourth mega trend, right? So we have seen India GDP growth, we have seen the Nifty and how much profit pool is being generated by BSE 500. The fourth one is always there is one question keep coming up about India trading premium to a lot of global market. And that's primarily because of our return on equity at the India level, aggregate BSE 500 is very, very good. So if you look at early part of 2006, 7, 8, 9, right? We used to make 4 to 5% more spread over the cost of money. It means clearly the business is adding value. And during this FY 13, 14, 15, 16, a very subdued period where India had a lot of macro issue, growth issue, this came slightly very close to the cost of money. So if you see the multiples of the entire India was also traded slightly lower. But if you look at off late, the last 3, 4 years, again, this number is going up, right? Now close to 3 to 3.5%, clearly reflecting corporate India is not only growing, they're growing with profitability, which is why sometimes the market will be little more elevated than our comfort zone. That's primarily due to we are more profitable than our cost of money. So the entire, a very good portion of India return is backed by fundamentals. And the last mega trend out of all which we want to capture is the entire premiumization story, which is happening in multiple sectors. And if you look at two data points to share, if you look at SUV as a percentage of a car sales, right, which used to be a very, very small segment 10 years back or 8, 9 years back, 15%. Today, steadily it is climbed to 43. What we are seeing as an allocator in every segment, we are seeing a very small component of the segments are growing much, much better than India GDP, right? And if you look at another example, like a green tea, which is growing at a 26% CAGR, vis-a-vis a normal tree, which is growing in line with India. So from an investing point, for all us, what we need to look at is within this 325 lakh crores, which is India, which are the sub-segments are going to grow better than India, and then find companies who are rightly positioned, has the customer wallet share to capture this entire growth. And then when the price is affordable, you end up allocating capital. So having seen the mega trends, right? Now let's go to what corporate India is talking about, certain major trends, right? As I told, we will speak on four major trends. The first one is economy, because it's very important. Not only I speak about the economy, what the corporate behemoth is speaking. And to start with, on Indian economy, we have listed two corporates. Obviously, there are many, but these two really cover the fulcrum of what our country is, which is SBI, which is the largest bank in India, and Larsen and Toubro, the largest EPC construction infrastructure behemoth. And if you look at SBI, right, the very clearly started stating that the outlook of domestic activity is brightening on account of sustained buoyancy in the service, consumer, business optimism, public spending, and infrastructure. If you look at the third line, Union government at historically unprecedented rate, the public sector capital investment has grown from 6 lakh crores in 2015 to currently we are spending 18 lakh crores as per the 2024-25 budget, which is a 3 times more, right? Clearly, the entire capital is getting invested into infrastructure. That is what propelling the economy. And if you look at the same, what is a very similar commentary you're able to see from even L&T, right? Where the fundamentals of Indian economy remain solid with healthy corporate and banking balance sheet and a sustained growth of an Indian economy, right? So clearly, the both larger organization and multiple organization commenting a very similar picture. Our economy is in extremely good wicket from a macro and the execution point of view. If you look at rural economy, obviously, right, this has been one challenge, and I thought it's again very important to see what the big daddies of rural economy talking about and where a potential opportunity can come to us in the next 1 to 2 year, right? Because if this pain is temporary, right, we will buy into the pain in the medium term where once the pain subsides, we'll be able to see the benefit of the growth. If you look at HUL, right, clearly admitting due to lower agricultural yield, the rural consumer sentiments remain subdued, right? Certain parts of the market recovering faster than the rest. So primarily urban growth continued to outpace rural. That's been very, very clear in terms of how the economy is shaped up so far. But the very good news is as the inflation stabilizing, I think this is one area where in next 12 to 18 months, we're going to see stabilization and the recovery coming back. But a very interesting, right? When the broad rural economy is not doing in a pretty great shape, there are certain companies are trying to grow better in rural also. One such example I thought I'll bring to your notice because not everything is bad is Dabur, right? Again, another a very large FMCG giant. Rural growth is in the range of 6.5%, where the urban for them is so close to 4 to 5, right? But if you see how they are growing, right, rural is growing out of their initiative of expanding their infrastructure, where basically they are reaching more villages in the last 1 2 years. That is leading to growth. So when an aggregate growth doesn't happen, we have to figure out companies which are going to take distribution-led growth rather than a penetration-led growth. So I think it's all about looking at the data from macro and also looking at the data at micro to find a right set of opportunities. So having seen the mega trends, having seen the commentary about India buoyancy, we have seen the commentary on rural economy. Now let's see one of the very temporary issue we believe, but is definitely hurting a lot of corporate India. Why I have choose to put this issue is couple of numbers of corporate got distorted during the quarter because of this Red Sea issue on two primary front. One, this led to hike in their logistic cost. So definitely they lost the margin. In couple of them, they lost the volume, right? So they also lost the sales. So that's why I thought it's very, very important to see which all company has spoken. So if you look at during last quarter, out of 652 company did the con call, close to 150 odd companies spoke about Red Sea issue, right? I'm sure as a long-term investors, you know that we have built a fantastic tech platform of ithought bot, where we put the entire con call into the cloud and then the run the analysis to find which all companies speaking these key terms. And if you look at couple of names, right, like Galaxy Serpent spoke about the Red Sea crisis leading to loss of volume, increase in transit time. So as I clearly told, they lost the time, they lost the volume, they lost the margins also during the quarter. A very similar commentary from Tasan Products, where they even commented saying last 18 to 24 months been a pretty challenging period for them in terms of the global, right? First you had the Russian gas crisis, then European crisis, US inflation, now Red Sea, right? So for a lot of global players, it's been a nightmare for last 2 years, I would say. But again, right, if you are a capital allocator in the medium term, the most important thing which we need to consider is, if this issue is temporary and which eventually will get resolved, how do we use this to our advantage to invest into right set of companies where today earnings are depressed, but in next 3 to 4 years, the earnings will recover sharply. So having seen Indian economy, having seen the rural, having spoken about the Red Sea issue, now let's talk about exports. I think apart from rural, this is one leg of our economy is not in a great shape. And but again, right, as I told, every temporary problem gives you a window to allocate more capital. So if you look at Bajaj Auto, clearly speaking about the macroeconomic environment combined with geopolitical issue remains uncertain, right? So from an investing point, very clear, corporate India is talking about global economy not in a great shape, right? So when you look at valuation, when you come with an expectation of a return, the commentary from corporate India is very clear. It is not an easy market. Still they are operating, they are doing good business, and they are able to show some growth, right? So I think we have to appreciate the context when we think about what to expect from corporate India in the medium term. So having seen the commentary, right, now let's get into the final, the most important third element of the entire session, which is the numbers. If you look at the numbers, right, for the BSE 500, the aggregate sales has grown at 7%. As I told, this is a particular window period where the growth has not come from very broad based. It primarily came from a lot of sectors facing infrastructure, so on and so forth. IT company, FMCG company had a very subdued growth, either because of the global slowdown or from the rural economy. Given the entire construct, right, corporate India still delivered 7%. But the most interesting thing which I want our shareholders, our investor to take it is the growth by various segments between large, mid, and small. Of late, there has been a slight hype or a misconception that small company tend to grow very fast and larger company doesn't grow. I think the truth lies somewhere in between. Obviously, being a small, if you have right capital structure and if you have right market opportunity, you can continue to grow much better than India GDP, which is around 10%. But it doesn't mean larger company doesn't grow. Let us look at the data, right? Large caps aggregately have grown at 9%, mid cap 7. Obviously, small cap doesn't have a lot of metal names and oil names, which grew during this period. D grew 3%, but there are sub-segments where small cap also has done well. But on an aggregate, if you were to look at, growth is also coming from large cap. So if someone is carrying the myth that only small is growing, I think the data is giving a slightly different picture. So the aggregate sales of the BSE 500 for the last 90 days, right? It's close to 36 lakhs to 37 lakh crores, right? Growing at 7%. If you look at the same sales by sector, right? So we look at the sectors from 2 points. One is deep cyclical, which is very sensitive either to Indian economy or the global economy, and shallow cyclical, which are generally less cyclical, right? They are daily need products or an utilities, which is extremely essential, right? So if you look at deep cyclical, right, oil flat, banking commendable growth, right, close to 30% at the top line. Auto came with a very strong set of numbers, and if you look at metals, at the top line is flat, at the bottom line pretty good. Infrastructure had a close to 18% growth. I think the one sector where the growth was extremely subdued in the deep cyclical is the chemicals. We have seen after a mega growth in chemical industry for the last decade, right? Last couple of years been a pretty challenging period, and that is getting clearly reflected in the top line having a negative growth of -16. If you look at shallow cyclical, right, FMCG again a reasonably subdued growth or close to a zero growth. IT had a very subdued growth of 4%, a very large constitute. Healthcare actually did pretty well in the last 90 days, right? Slightly above India GDP, clearly reflecting among the defensives, healthcare did very well. And if you look back the price, right, clearly reflecting a lot of healthcare stocks hitting all-time highs and lifetime highs. Alcohol did grow, but it's a very, very small base, right? Around 14%. If you look at PAT, right, having seen the sales, if you look at PAT has grown very, very commendable 19%. So you had a sales growth of 7%, PAT growth of 19, clearly reflecting this quarter belongs to subdued top line, but improved operating leverage and the margin recovery due to commodity price falling, right? If you look at auto had a margin expansion. If you look at pharma had a margin expansion. So a couple of sectors clearly taking the benefit of lower commodity price, and that is also coming from the lower global growth. Again, if you double click and see the segments where it has grown, large cap profit has grown close to 23%, primarily led by banks and metals. A mid cap 5 and small cap 6. If you look at small cap, the top line had a negative growth, but at the bottom line, it still grew at 6%, beautifully reflecting the margin expansion, right? But again, as I told, both the sales and the profit, one data is very, very consistent. Growth is coming broad-based. Large caps also growing much, much better, or even sharper than even the mid and small cap. If you look at the entire 3.34 lakh crores of a profit, right? One of our mega large cap fund, which is True Blue, right, we invest into 23 stocks currently, which captures 28% of the profit pool. So any investor who have a very long term want to have the mega cap investing portfolio, right? This is what we end up investing into, right? With the most profitable part of the BSE 500, we will try to invest into our large caps and our multi cap. If you again subdivide this entire PAT, right, by sector wise, as I told, again, every sector we look at deep cyclical and shallow cyclical. Banks continue to grow, right? So one of the commentary keep coming up in our conversation is banking stocks have not done well. Is it a long-term issue? Just look at the profit pool, right? Banking produced 80,000 crores of profit amount, 17% growth, clearly reflecting the underlying growth is far, far superior than India GDP, right? So banks are continuing to deliver a very good growth. It's just that technical selling happening from an FI, which is leading to a suppressed price action. But on the fundamentals, these companies are tend to grow between 15 to 20%. I'll share a little more data on company specific. Crude oil did pretty well, basically due to it. Automobile, I think the biggest star sector, I would say, is two sectors. One is automobile, had a phenomenal growth right from Maruti, Mahindra, Bajaj Auto, Hero Motocorp also revived, Tata Motors have revived. So larger companies have done extremely well during this last quarter. Iron and steel, as I told, margin recovery being the big pretty play. If you look at IT, right, again, very subdued growth, large sector, FMCG subdued. But healthcare, on the right hand, if you see, healthcare grew at 29%. So clearly reflecting among the big sectors, you had auto and healthcare did extremely well. You had banking did good. IT and FMCG had a very, very subdued during the quarter. This is from a broad sectors. Again, one of the sectors has shown extreme stress is chemicals, and clearly, right, even at the PAT level, chemical sector is down 50%, clearly reflecting the underlying issue at the chemical sector. And agri also is another sector, clearly is going through a pain point. These both are primarily pain point due to global slowdown at one level, destocking of inventory, right? So a lot of these both supply side issues and the demand side issue hurting both the chemical and the agri chemical side. If you look at This is a one very interesting way we look at the data. I'm sure our investor would have attended the previous corporate India, right? I've seen this, right? Again, I would like to reiterate what it is. How we look at this data is there are particular sector where sectoral growth itself is extremely high. There are particular sector where sector growth is broad based, where there are some companies are growing, some companies are not growing, and there are certain sectors where the sector itself is actually degrowing. So let me give some example, right? Healthcare, the first sector out of BSE 500, because it has 45 names in BSE 500 in healthcare. In BSE 500 is healthcare stocks. Out of 45, if you look at number of companies have grown more than 20%, which is 25. And if you look at number of companies have degrown, which is 11, and the slow growth is 6. So if you add this 25 and 3, which is 28, and then divide obviously by 17, you will see 1.65, right? So for every one company which is slow growing, there is 1.65 companies are fast growing, clearly reflecting the underlying momentum in the sector. If you look at another sector where the underlying momentum is extremely solid is autos, which is reflecting as a 2.55. It means out of 39, every company which is growing slow growth, there is 2.55 companies which is growing fast. So in this two, right, primarily getting the sector call is very, very important. Why? The sector itself is going through extreme tailwind. As long as you are well allocated in broad-based name, you're going to capture a lot of value. That's point number one. If you look at sectors like IT, the number is 1.13, right? Which is on the fifth one, if you can see. There are 32 company got listed. There are 9 company grew more than 20%, and there are 8 company had a negative growth. What does it tell is if you want to allocate money into IT, what investors should have seen is within 32, there were few names did extremely well and few names did do extremely bad, right? So it's all about stock selection becomes a very primary driver of creating value. I'm sure our long-term investor, you have experienced a couple of our IT name, which we have exposure did extremely well, right? Clearly reflecting in IT, it's all about stock selection is far, far important than what happened in the broad economy. And if you look at two sector, which is clearly showing very anemic growth, again, you have to be very specific to find value. One is chemical and FMCG, right? Where for every one company which has not done well in terms of, right, if they have less than 10% growth, we classify as a low growth. And if you look at high growth, it's only 0.4, clearly reflecting there is more slowdown than the rising. But even in FMCG, you have 6 company which grew more than 20%. It's become even more sharper. You need to find value in a sector where the sector has a headwind, but still, if you can find good opportunity, which can actually have a tailwind. So this is a one beautiful way for us to see which sector is doing well, which sector is slowing down, where the sectoral trends are happening in a very nuanced manner. And at aggregate, on the right end, if you see for 499, because NMDC Steel is not listed for both the period, so we are only 499 company as our universe. 1.25 is a number clearly reflecting there are more growth stocks than stocks which is growing slower. So that is what our bullish view in the medium term. Having seen the PAT growth both by large, mid, and small, and by sector, now look at how many companies are growing or what is the absolute profit level, right? So if you look at again absolute profit, there are only 70 odd company delivers more than 1000 crores of profit, clearly reflecting this 1000 crores of profit is a very, very coveted position, and the number is today only 70, right? And if you look at the number of company in deep cyclical, there are 28 companies loss making. So if you look at BSE 500, 32 company out of BSE 500 is today loss making, right? And if you look at 0 to 100 in deep cyclical, it's 111 companies, and shallow cyclical is 40. A very interesting trend if you look at, you have 111, then you have 91 company doing profit of 100 to 250, then it is 53, but then it is 34. Naturally, our tendency to think about is the 34 should go down, right? Because the larger the profit number, the lesser the company. But very interestingly, there are 58 companies delivering in deep cyclical segment itself more than 1000 crores, reflecting the scale advantage what certain company comes in, right? They actually go into next orbit. So our BSE Finder is a very good representation of large, mid, and small. And I think this data is beautifully depicting you have every category of profit companies are there in part of BSE 500. And the last one to see out of BSE 500, the way we see is the profit is very concentrated on top 50 and the bottom 450. Again, if you look at Nifty 50 stocks, which is only 10%, this 10% of the entire BSE 500 captures 56% of the entire profit pool, right? Again, clearly saying as an allocator of a capital or an investor, it is always very good that you should look at the portfolio in two dimensional. One, investing into a very high quality portfolio which invests within the Nifty universe, which captures a very good portion of the profit pool, and then having a very diversified fund like our solitaire and then spear, right, which allocates capital across the broad spectrum, which also captures the broader profit pool. So if you look at ithought within the four funds, right, clearly the differentiation is bringing in both the profit pool can be captured by our investor by allocating into various funds. So having seen the entire sales and profit, this is our mother of all slides for people who are following us. What this slide talks about is the entire 499 companies bucketed into quadrant: sales growth, profit growth. So I'll first talk about this green quadrant of four boxes, light green, where you have this number 15, 54, 14, 86. What it clearly tells is these are the companies which has grown both sales and the profit more than 10%, right? So this is a beautiful quadrant. Our portfolio, most of the portfolio should be somewhere close to this, where the top line is growing, the profit is growing, the cash flow is growing, and the dividend is growing, right? So this is a big segment which is close to 169 companies have grown both the sales and the profit more than 10%. But very interestingly, from an allocating capital point of view, the number 72 or the number closer to 72, which is 12, 51, and 24. If you look at that four boxes, right, this is a segment where currently the performance is very, very subdued. But if we believe the entire problem is temporary and that this temporary issues goes away, eventually our opportunity to invest also comes from this quadrant. So this is one of the very interesting chart to see how the two-dimensional both sales and profit is growing. And if you sub-segment and see, right, this 86, which is the sweetest spot if you are already into the stock, right, where the sales is also growing 20% and profit is also growing 20%. But typically, these are very good stocks to hold. Why? With this type of a growth, the stocks are generally tend to trade very elevated valuation where we cannot buy in this universe, but definitely if we are stayed invested, we will hold back. So having seen the mega trend, then we have spoken about the commentary, then we have seen the numbers, right? Now let's see what's a broad outlook, certain very interesting things which we have observed out of corporate India presentation or the commentary. The first one, as I told L&T, right, very clear. The last 3 years story is all about infrastructure. I think no better company to represent what is happening in our infra, none other than L&T. And if you look at a beautiful picture they have put out in the PPT, I thought it's very important for our investors to see and understand how India is flourishing, why India growth is far more sustainable than a past cycle. If you see on the left side, right, growth continued to be led by investment. So this is one growth in the last couple of years led by investment and not by consumption. So public capex, which used to be 6.9% of GDP, as per 24 budget estimate is 8.3%. Clearly, India is spending a lot more money on capex, which is very, very positive, which is where we are building metros, airport, roads, and every infrastructure what we see in every state, right? And look at the commentary on macros. Growth is good, inflation is stable. This time, very rare exceptional, India inflation is far better controlled vis-a-vis what the global, right, which is US and Europe, where during COVID, they have actually did funding lot more than what was needed. And eventually post the recovery, they are seeing a very significant inflation that led to the hike in policy rates. I think India inflation was much, much better handled by the government. Our current account deficit is pretty good and balances are good. Forex reserve continue to rise, right? From L&T point of a lot of infrastructure, even Saudi is doing very well and a lot of our companies are exposed, right? So clearly reflecting there are various countries which is growing well. And I think our infrastructure story is just started. If you look at banking, right? So why banking is a very important sector to talk is, if you look at every what is the index, 35 to 40% of the index is a banking from a weightage point. So it's very, very important to know what's happening in our banking. And if you look at credit growth, right, a very healthy 15 to 16% growth. So as I told, India is growing at 10. 1.5 times of India growth credit is a very good ratio. Indian banks are growing anywhere between 15 to 16%. But primarily credit is coming from retail, service, agri, and a little bit of industry. What we see in the medium term, given the RBI little more pressure on the retail, which is also very, very important side, so that we have very extended period of growth. I think the growth will get broad-based. There will be a lot more opportunity will open up with industrial credit growing, and that's what we are aiming to capture in a couple of our portfolio stocks. Um, if you look at sub-segment, right, I have just highlighted a small snapshot of how banks have done across various parameters of growth, which is advances, deposits, CD ratio, CASA, term deposit, net interest income growth, pre-operating profit, PAT growth, ROA and ROE. The highlighted portion is a very important why. This reflects the core growth of a banking segment. And if you look at the large private banks, which constitute a very large portion of any index, has grown the core NI growth or the PPOP close to 15%, right? As I told, very, very healthy growth. So when we look at the entire commentary about banking as not doing well, it's a one-dimensional data about the price of the stock. This is what the opportunity for any long-term investor, right? If you find sector is growing between 10, 15, 20% and the price has not moved, it means the window to allocate capital is still open. Those who have 4 to 5 year time horizon should invest, right? And clearly data is in front of you. If you look at NII growth, Axis grew close to 10%, HDFC 23, definitely due to merger. ICICI 13, 14%, Kotak Mahindra 15%, right? So clearly these are not a no growth sector, right? Growth is happening. Obviously, price has not performed for a lot of technical reasons and the slight concern on the slower deposit growth, which we believe should be a very temporary phenomena. As the inflation stabilized and the policy makers want to keep the growth, right? One way is to improve the liquidity, and eventually this liquidity will flow back to deposit growth. Having seen the entire infrastructure commentary, then we have seen the banking. The third important sector, which we believe has gone through extreme pain for last decade and just coming back, is telecom. And again, read a very interesting chart put out by Reliance. And if you see in the right side picture, right, what a transformation our telecom infrastructure has happened in last 1 year. This applies both to Bharti and Jio, but Jio has put out this beautiful slide where if you look at December 2022, hardly we had a 5G infrastructure, and just ending December 2023, almost the entire country is 5G enabled, right? Clearly reflecting the beautiful infrastructure we are building, both physical and even digital, going to propel the economy next upcoming 5 to 7 years. That's what I said. With 327 lakh crore economy, which will end next year, our ambition is how do we capture the best of the growth when India will turn 1,000 lakh crore economy? And I think telecom is going to play a very pivotal role. Today, ARPUs of telecom are sub 200, are close to 200 for a couple of players. The return on capital employed is extremely subdued. So they have invested into infrastructure. I think in next 5 to 10 years, lot more productivity will come out of these assets, which should be very positive from a sector point. The fourth sector where we are pretty positive in the medium term is pharma. Rightly, the data is supporting. And this again a very good data shared by Cipla, one of the very large player in the Indian pharma company. And a couple of data points they have talked about why pharma growth will happen. One, lifestyle changes have happened very big time. If you look at chronic growth is being extremely higher than normal non-chronic ones. Proportion of chronic ailments is going up. Demographics, elderly population is going to grow. I'll share some more data in the next slide. And awareness has gone up, right? So clearly, I think um, pharma, he is behaving very well, both from balance sheet, cash flow. India growth continued to be close to the 10%. And if you look at off late, the big surprise came from US recovery, which we also believe is an add-on factor which will support the stocks in the medium term. On the pharma, one more interesting data I was going through one of the presentation and I thought it's very interesting to share is India population mix, right? So we are a very young economy, no doubt. I think that's a very bright picture in the next 5, 10, 20 years. But again, in this data, there is one more data which was least spoken, but I thought it's very interesting is the old age, right? How much old people as a percentage of our population, which used to be 6.8% in 1991. In 2001, it was 7.5. If you look at the difference, which is only 0.7, the next 10 years, the 7.5 has become 8.6, which is 1.1%, right? So if you see every 10 years, the percentage is growing and growing at a growing rate. 2011, 2021, from 8.6, it's gone to 10.1, again 1.5%, right? So steadily it is growing. And in next 10 years, right, we are already 3 years out, this 10.1 will become 13.1. I think the inflection point has hit. Clearly, we see people above 60, 65. If you see the medical expense is dramatically rising, right? So pharma is one sector where, as allocator of capital for us, it's very clear after next 10, 15 years, the growth can accelerate. And that is where, as long as if you invest into a very well-managed company, both from compliance, quality, price, distribution, product, and strategy, I think this is one sector where the weightage of this entire segment substantially will rise in next coming couple of decades. The last before one interesting segment where we are outrightly very bullish, we see this mega way of luxury wealth is going to give lot more window. I'm sure our investors knows the portfolio, right? What types of names we have allocated. And if you look at one interesting data came from Prudent, again, this company we don't own, but I think the data is very interesting. India as a society saves 30% of their entire thing as a savings, right? So we are a 300 odd lakh crore economy, saves 30%, so close to 90 lakh crores we save. Obviously, right, public saving is 20%, which is 60 lakh crores. And if you look at insurance, right, insurance premium alone is close to 10 lakh crores, right? So a lot of sectors are going to grow and India itself is growing at 10%, right? So if you look at wealth management, we believe in the medium term, wealth management can grow anywhere between 1.5 to 2 times of India GDP itself, right? So clearly, next 10, 15, 20 years, this is one segment which we expect it will flourish a lot and there is a lot more wealth to be created for our shareholders. The last sector which we thought I'll cover up is the consumer. There are mixed reaction, right? Obviously, as I've shared in the data, consumer segment is not firing in all cylinders. But very interestingly, when the entire country consumer is not doing good, one way to look at, again, the data is there any states are doing good? And if we find any company which is only particularly in that state can do well, right? So I'll give you a couple of examples. If you see on the right end, the aggregate GST growth for 4 years is 13% CAGR. That number is very important. And if you look at a couple of segments like Maharashtra is growing at 15%, Karnataka is growing at 15%, Andhra is growing at 14%, Haryana is growing at 14%. So when an aggregate growth is 12 to 13, and you find some states are growing at 15, 16 types, right? Odisha is growing at 16, right? Clearly reflects our opportunity is not at aggregate India. Our opportunity could be a very disaggregate, right? So if you find a company which is only part of Karnataka and Andhra, maybe these companies can have a better growth. Why? At state level, their growth is much, much better than India. So from an allocator point, one, you should look at India growth. One, you should look at state level growth. Then finally look at how companies are executing the strategy to capture the growth, right? So it's a multi-dimensional way to look at data to capture the best of rewards. Consumer segment has been soft, as I told, we have shared the aggregate number. This is the disaggregate number. FMCG very muted. FMCG broad growth is 3% aggregate. barring two companies like Nestle and Tata Consumer, which is primarily premium affluent-led companies, which has done extremely well. HUL, which is a behemoth, clearly reflecting a 3% growth, right? Underlying pain is well reflected. Paint, the story of two parts, sales been subdued, but operating profit and PAT grew very phenomenally, reflecting the lower crude price, lower chemical price. So it's a story of margin expansion. QSR, again, very, very bleak out execution, aggregate sales of 9 and huge pressure on food related stuff and rental cost all. I think they had a collapse of profit pool during the period. Discretionary, again, a very mixed one. The primary two company drove the entire discretionary is Trent and Titan. Jewelry as a space did pretty well. Trent is again an exception, but otherwise broadly a very muted, right? If you see Page, which was erstwhile used to be the darling of companies, right? Clearly, when you pay up 50, 60, 70 times multiple and the growth doesn't come, it reflects a lot of price action, which we are seeing in Page in last 5 to 10 years. Uh, so having seen the mega trends, having spoken about the commentary, number, and the outlook, the final question before we open the floor for question is, are there enough opportunity, right? Because we are at this point in time, 3 years of actual bull run has happened. And in last 1 year, we hardly had any correction, right? It's been a relentless one-way market. Those who have already invested definitely have taken the fruits. But do we find still opportunity? Answer is yes. And I'll share some areas where opportunity is still open for anyone to allocate capital in the medium term. The first good news for us is corporate India continue to fire, which is getting reflected in the earnings estimate. So what does this picture tells? A very interesting data on EPS of the Nifty, right? So we see Nifty value every day. But what is more important, the underlying earnings of Nifty for FY25, which is the light blue. If you look at early part of this year, 1094 was the estimate, which broadly been very managed, right? Even the last 8 months, the number is close to 1070 to 1090. So the typically what happens, the numbers are very high in the beginning. As the number becomes real, the numbers go down. But off late, what we are seeing is corporate India is performing because of economic activity is extremely good. So the earnings is very, very stable. So that's the first good news. The fundamental expectation of Nifty will be close to 1070, which is the EPS. So when you look at market right at 22, 23,000, right, we are trading anywhere between 20 to 21 times on your forward types of a scenario. But very interesting again, right? Having seen the expectation is very stable. That is why the market continued to rise, where the incremental growth is going to come. And that is where in few of our portfolios, you will see certain higher allocation to some sectors. And that's where, right? So if you look at financials, which is going to contribute 31% of the incremental growth. If you look at various other sectors are going to grow. One sector where we think the growth might not happen to the extent what the general market expectation is technology, where general consensus is it can grow between 14%. But what we believe as a house, tech, given the rupee stability, it could be a 8 to 9% type of a growth, which can disappoint a bit, right? So, but market clearly pricing in, that's what the stocks are reflecting. So any disappointment on the commentary, which should happen in next 1 month, where the tech companies will report and will guide for the FY25, I think the price adjustments can happen. But primarily, the growth is going to come from Nifty, couple of metal stocks. And if you look at telecom, where a large growth is going to come, right? 78% growth is expected in telecom profit pool, clearly reflecting one thing as a customer, ARPUs are going to go up. We are going to pay a lot more. If you look at our data consumption in the last 6-7 years has grown exponential, but our telecom bill has not even grown in line with inflation. I think this is a disconnect. I think what industry is anticipating, and for right reason, is I think there will be repricing of the telecom bills, which will happen at the consumer level. But from an allocator of point of view, we can capture the entire growth with either investing into Bharti or Reliance. But Reliance is a much broader play. You have to take a view on retail. We have to take a view on Jio. We have to take a view on the entire petchem, right? Healthcare is expected to also do well. So this is from a subsegment. The opportunity window will be there in multiple sectors. Finally, valuations. I think at the broad level, valuations are okay, right? As I told, we are in the beginning of the earnings cycle from a 5 to 7 year. Economy is in a very good wicket. Our return on equity is improving, right? When all this good metric is there, 5 to 10% premium is not a big thing. And if you look at 1 year forward, right, broadly market is trading close to the 20 times average. So I think at a broad market level, we are fair. So the return expectation has to be a little more reasonable, unlike in the past where the market was cheap to begin post COVID and we had a bountiful, right? The sectors where clearly, again, you double click the entire space. There are few sectors where very, very interesting. One could be banking, one could be insurance. If you look at consumer staples, right, after a pretty long period of a bull market, last 3, 4 years, lot of consumer stocks are underperforming and coming to a zone where in next 1 to 2 years, if the price corrects a little more further, there could be very interesting opportunity opens up, right? So clearly, it is not one picture all right. Every segment is expensive. Definitely, there are few segments where valuations are not comfortable. We have to be very, very watchful. Segments like few of capital good companies, few of companies where which is primarily led by government-led business, which is growing at a multi-decadal valuation. We have to be mindful. This is not the market where we only speak on return. I urge all our investors definitely take a very good cognizance how your portfolio manager is taking risk, right? What type of a risk is avoided in the portfolio? How well the portfolio is well diversified? Is it capturing multiple growth? All these things will be important because given the 3 year bull market, I think it's very important for all of us to protect the wealth which we have got and then grow from here on. To conclude, economy is in a great shape. Corporate India is firing in all cylinders. I think this is a primary bedrock of our medium-term positive. Finally, valuation. I think if anyone has a 4 to 5 year outlook, definitely there is window to allocate capital. But this is a market where both risk and return has to be seen in the same way to capture and benefit the medium-term picture, which I rightly told. When India will become a 1,000 lakh crore economy in next decade, right? How well we will capture is our story. Thanks for this opportunity. Before ending the entire corporate India, this is one interesting data on how India has performed, right? Nifty over a long period has done 10%. So from a return expectation, we clearly see over a long period, markets have delivered 10 to 12%. So thinking in the medium term, anywhere close to 12, right? I think that's a right expectation which investors should have. Last 3 years have been phenomenal. I agree. God has been very kind. We are very, very lucky in that way, capturing the growth. But I think we need to appreciate these are short-term phenomena. In the past also, short-term returns used to be very bumpy, but eventually in the long term, the returns are anywhere between 12 to 15%, right? If you look at 10-year return, on an average is 12 to 15, and even a 20, 30-year return, it's close to 10 to 12. So from a long-term investor, India does 10%, 12% is what markets have delivered. Anything about 12 to 15, I think it's a fantastic return. And if this return is achieved with a lower risk, I think it's a fantastic outcome for all of us in the long term. Having spoken all, I think we are very happy to share our last month data, the 4 major funds which we have. Solitaire, which is our flagship scheme, around about 1,000 crores of the assets. God has been very kind. The markets also have done very well, right? From inception, index have done 21 odd percent. Fund has delivered close to 27 odd percent. Post all expenses, this is True Blue, the mega large cap fund, India's first fund where the entire stocks are invested within Nifty 50. So very high quality large cap investing. Vriddhi, which is our small and mid cap, done phenomenally well from the inception. And our Sphere, which is our multi-asset, again have a phenomenal track record. So I think we have built a variety of portfolio capturing the India growth based on client requirement. I think 4 funds are here to serve you well. And thanks for the opportunity and thanks for your patient listening. We'll be happy to take the questions. Thank you. Over to you, Tarun.
Yes, sir. Now I'll be giving them access to video as well as audio. Just give me 1 second. The access have been given, so you can voice out your questions. Thank you.
Uh, Hi Balaji, this is Sunil here.
Hi, yes, sir. I'm not able to
I'm
see.
audible?
Okay. Yes, sir. Yes, sir. Very
Yeah,
much.
yeah. So, wonderful presentation. Thanks for giving us all the outlook uh, for the on the macros as well as micros. Um,
Thanks, sir.
One, yeah. So one question which has been a constant niggle with me, or it's probably in my mind, is that how long market cycles are becoming shorter, macros are changing very fast, right? And conceptually this whole thing of sitting and waiting for the performance is something which like say for example the banking sector, like I've been holding Kotak through your PMS as well as not through your PMS but with other PMS as a stock, and HDFC Bank as a stock for last 3 to 4 years now, right? And the performance has not been there in spite of PAT growth, in spite of sales growth, NIM growth. Everything has been wonderful, and still the stock doesn't perform, right? And conceptually, are we right now in saying that is this the only way to invest, saying that the PAT and the sales growth are the driving factors for the stock price? Are we correct in saying that in the current market scenario which is there for the last 2 3 years? Because it's not only the DIIs and FIIs, it's also the retail which is playing a very big part in the market growth, and the sentiments on the retail is what is driving the market growth, right? And
I
in all
appreciate.
these presentations, whatever the PMS houses give, it's all the traditional data and historical data. I mean, when I say traditional, I mean the historical data, and with an end objective that yes, the PAT is growing, the sales is growing, let's wait and let's come to a place where things will turn out to be, and that's what has
Yeah.
been happening historically, no denials about that. But in
Right.
the current market scenario, when the market is on a bull run for the last 3 to 4 years, if a PMS house doesn't deliver returns beating minimum 15-20%, right? It looks to be little, very difficult to savor, how long to wait, wherein
Sure.
you invested, and the smaller PMS houses, for example, when you look up all the datas on the net for the other smaller PMS houses, they've been doing pretty, as risk is high, of course.
No, I understood, sir. I understood.
Yeah,
I'll
so
answer you.
yeah.
I'll tell you. Investing is a 100, 200 years field, right? So let's go back to data of 100 years, 200 years, right? Instead of very short period of 2, 3 years are very, very short, given what the context of this entire industry. One data is very simple. Why did I say sales and profit? No, relevant to society. If you are serving more people, generating more sales, sales converting into profit, profit to dividend, dividend to cash flow, dividend then expansion, right? Clearly the company has become create more and created value. Value should reflect into price in the long term. But as you rightly said, in the short term, which could be 3, 4 years, right? We saw many names. I'll tell you, if you look at Nvidia, which is going to be a 2 trillion plus stock, right? Had a very long period of negative return, had a very long period of zero return. Apple has gone through in last 15 years, 4 periods of 3 years zero return. So one, either you have to have one belief, and clear belief in the long term is very simple. Company has to grow sales, sales leading to profit, profit to cash flow. Why? The cash flow will become dividend, right? Which is real in your hands. In temporarily, as you told, there will be distortion by by the various participants, and this time the distortion has come from retail, no doubt about it. But think about as a very fiduciary led business people, like what we do end up in PMS, right? We need to do what is right. We just cannot do what could be. That's one reason. I don't want to make a name specific, but one of the problem with these companies in the beginning is if you overpay any stock, even though profit grows, it has to go to a period where the derating has to complete. In HDFC or Kotak, to starting point, which some of couple of fundos have invested, right? The valuation was not very attractive. This is where I say when someone owns a company at 70p, 80p and say, right, I'm a 100-year investor, 20-year investor, I'll stay invested. I think the question is, 4-5 year period of a zero return, not because of a company. The investor expectation was so high 5 years before. Now that is getting reset. But you take any 15-year period, you show me one company which has grown sales, profit, dividend, and the price has not gone up in 15-year period. I think then there is no one company in the entire world. But what happens? This is your window, right? If you have more money, you either allocate. I'm not saying direct stocks, right? Because this forum is not for that. But clearly, value is created by selling more to more people, converting the sales to profit, profit to cash flow to dividend, right? Which is really hits the bank account of the shareholders. You see every company created wealth for 15, 20, 100 years have done this. The question in this is, should we pay right price? I think people who have bought companies thinking this company will always grow, paying 6 book value is paying the price, right? This is where as an I thought, we are very, very cognizant. It's not about buying the great business. You have to buy great business at the right valuation. And I'm sure you would have experienced in our fund, we are very, very cognizant on the price you pay, even though asset is a coveted diamond.
Yeah,
Hope,
completely agree. Completely agree. I think yeah, the thing is, one thing could be more good in this when we do reviews about PMS's portfolios. One thing good would be, what are the future plans of the companies if we can cover, right? Like of course that will be to every, it's this more presentation on a macro thing, but if the future plans can be covered and how does the forward P look like, probably that things will help.
I think, see, one thing, sir, I'll with all the respect, these things are changing. So you have given to a fiduciary, right? Who have been the only thing we do is money management, right? So we have 10 analysts tracking every day. Every company has a mother document, baby document, traces of mail, so much of thing. I think from your point is what is our commitment? Our commitment to our shareholders is simple. Inflation is 5-6, India is growing 10. Over a period, broader market will do 12. Our expectation in a couple of funds, right? At least I'll take Solitaire, which is a flagship, is around 15 with a lower risk. I think over a 4 to 5 year period, as long as we get there, right, you should not attempt to wipe. Like, these are very complicated. I can always share it, but it's going to be fleecing, right? Tomorrow morning, there will be a change in the outlook. We will change the estimate. So none of these numbers are very sacrosanct. What you should ask is portfolio getting very lot more changes are happening? Why you are happening, right? If you're saying long term, I should not trade it, right? I'm sure if you are part of our fund, which I don't know which fund, none of our fund do churn, right? We really, really long term investor, right? Reflecting what we say, what we do is very, very consistent. I think these are the things which you should measure, right? Hey, Balaji, you spoke about long term, and I see your portfolio is getting churned a lot. Then there is inconsistency. We should converse. Otherwise, I think we are happy to deliver. I'm sure the track record is phenomenal. Hope I
Thanks,
answered your question, sir.
thanks,
Thank you.
Balaji. Thank you very much.
Yeah. So you can close your this one. Sorry.
Balaji, this is Shilpa here.
Yeah. Hi,
Fairly
ma'am.
new in the system. Hi.
Thanks.
Thank you so much for this. This is my first presentation, so very, very insightful.
Hope you liked it. Yes.
And
Thank you.
yeah, it's amazing. And your earlier answer was also very good. I loved your philosophy, and that's
Okay.
also the reason I'm here, of course.
So nice. Thank you.
My question is, do you have a view on the liquidity of the market? Because besides all these things, the other factor which is likely to decide the flow and this entire how well the stocks will do is also liquidity. And then it is again dependent a lot on FII. And I think today somebody sent me one article of Beerston where the guy says that expect the funds to flow out of India. So do you have a view on this?
I think when I look at data, obviously we have a view, but you can always take it for granted. Liquidity can only temporarily bump up any stock price. Correct? It's just like a flow, right? When the flow comes in or goes out, it can impact the stock price for that time moment, which can be a 30-day, 60-day window. But given as a house, right, we take every decision giving 4 to 5 years. The primary driver is the intrinsic value growth, which is, as I told, right, sales leading, profit leading, cash flow leading, and dividend leading. So liquidity can happen. I think we don't have a very strong view that FIs will sell. Why? FIs have actually underinvested. They have missed the bus. They are most bullish about us. Obviously, there could be a tactical trade which they will do in China. They will go to US. But in the medium term, FIs. But I think the biggest bull of India is no more FI. The biggest bull of India is domestic retail. And I was looking at one data which if you want, I'll share it post the call. Consistently we are getting $3 to $4 billion from mutual fund, right? It means that data is not changing. You close every 30 day, you're going to get 20,000 crores of money in the form of SIP, right? Clearly reflecting Indian biggest story is now appreciated by retail. That is what supporting the market. So I think the flow will be positive in the medium term, not taking any short-term views, which can happen, right? Given the election, they can take a view which I'm not aware, because there are 100 sell side will give 101 opinion. What we primarily see is the long-term factors for FIs are very positive to be in India. They missed the big bull run in the last 3-4 years. They underinvested. They are also waiting for an opportunity. I think any given opportunity in the market, I think FIs are going to be big buyer in India, and none other than our Indian retail is buying, right? So I think we have to more worry about Indians are buying and buying in a very fast manner. So liquidity is very positive for the market. That's why the market is very elevated.
Okay. Thanks. Thank you so much.
Thanks, man. So before I get some question, can't hear, reset. I'll just take some questions as come in the chat box. Recently, PSU sector has been phenomenal growth. What's the ithought view on PSU? I think 3 years back, we had a very, very positive view on PSU. In a couple of funds, we did played. Still, we have some exposure. But I think given the whole construct of the sector, which is low in terms of growth driven by government, I think the re-rating has been phenomenal now. I think this is the time either you hold on to the position or selectively you also sell down, and not this is the time to add on, at least in our view, right? Hope that answered your question, sir. Insightful. Thanks. Hope you liked it. It added some value. What do you see impact of US debt ceiling? I think all this debt ceiling, growth concern, inflation, everything will come. But whole idea is we are investing into well-managed company, given a 4 to 5 year outlook. India is in a great wicket, as I shared a lot of data. I think all these things will be a very temporary. From your point of view, there are only two things we need to look at. Do you have the time horizon of 4 to 5 years to come into equity? And the return expectation should be close to 15%. I think if you have both, we will be very well serving you in the medium term. Hope that answered your question, sir.
Balaji, hi, this is Kalyan. Can I go now?
One second. Yes, sir, you should. Madam, can you close your window? I think it's still on. Just, yes, sir, you go ahead, sir. I think.
Yeah,
yes,
so see, the question is follow through. I mean, I think Madam took half the question away, which is that, see, right now, Japan interest rates have gone up, and Nikkei is also at a high, and so there is a one view that there would be funds which will be flowing into Japan and into maybe into Japanese debt also before equity, whatever there is something else is there. So while you said that domestic SIPs and investors have been some kind of a cushioning effect we are giving to in case the FIs don't come, and FIs have underinvested and all that. Do you see any event risk because of, let us say, geopolitical or anything like that, which could upset this apple cart? Because the sentiment is now got super strong tailwinds. India shining, whatever, India shining in the new form, wish it India, whatever that whole set of catchphrases are happening at this point in time. So there is obviously going to be something which may go wrong. We don't know. No, I don't want to be throw a towel on that, but I just wanted to check.
1 second.
Yeah, get that thought on that. Yeah.
Mayandi Chettiar Palani. I think someone. Can you put off your cam? Yeah, thanks. Sorry, sir. I think your question is very valid.
Yeah.
I think definitely the narration is very strong.
Just another thing. There's a great PPT, and I really enjoyed it. It is just that I'm on the road. I took it on mobile, so some of the data points I could hear you. Thankfully, you heard it because we couldn't see it. But it's a great PPT. Please, my compliments to the entire team for that.
Definitely, sir. That is a fantastic thing. Thanks. Because of all you only, we are there here. Coming to your question, I think your question is very valid. It's been a great time, both at macro and micro. That's why I rightly said the FIS can take a tactical call in a 6-month outlook. I think instead of anticipating the FII move, the biggest time spent for us is which is a one country if you have to nail down which is going to grow not for FY 25, 26, 27, 28, 30, 35, 40, right? 10, 15-year outlook. If you have to take one country, right, the country is clearly belongs to us, right? So we are in a very, very, I would say, lucky position to be in this country at this point in time with the government policies are very, very consistent. So the tailwind is extremely good. But as you rightly said, the challenge today is when the entire narration is good, this is where I told in the end of my call session also, we need to manage risk well. And if you look at the way we are managing risk, we are trying to trim position in areas where the valuations are turned extremely unattractive. If you have to look at the day one deployment has come down substantially for our new clients, close to 30 to 40% is what the day one deployment in multiple of our funds. So we are trying to manage the risk in multiple form. This is clearly the time to manage risk and deliver return and not take a very naked risk, right? So I think it's very, very important. We should have a 3 to 4 years horizon. Return expectation should be close to 14, 15%. And people should manage risk because after 3 years of a bull market, the biggest mistake is done by both fund managers and the investor is one, investing into low grade companies from our end and having high expectation of return because last 3 years returns have been anywhere close to 20, 25, 30%, right? But in the long term, these are non-sustainable. Let me be very, very clear and blunt. In the long term, anything above 15, it's time to celebrate because India has only delivered 10 to 12 in the long term, right? So we delivering 15 itself is a good outcome. I think the more we appreciate that outcome in the medium term, we will be having a very, very happy discussion as every 90 days we will be having on the corporate India. Hope that answers your question, sir.
Yeah, right. Just one more thing, because if you just come into sentiment, so what should an investor with fresh funds do? He should get into Sphere because that is the low risk product for the next 12 months, and then pull out a Sphere and move to Vriddhi, is it? Which I don't know, which may not have my my chartered accountant's approval for because debt taxation and all that, but definitely is that the kind of tactical thing that one should
do that. Don't do that. You take a primary allocation on how much time horizon you have. We cannot precisely plan a 1 year, sir. I think the whole idea is you should have a 4-year outlook. And if you're not overexposed to small cap, you can still give it to Vriddhi, right? The way our portfolio manager, where Rohit Rajat with Sham being the fund manager, we are very clearly deploying in a very, very slow, calibrated manner. And I also shared a very interesting data on sectors which is going through pain, right? Which could be export led, which could be agri led or consumption led, right? So there are small window of opportunity still open where our portfolio managers are allocating capital very slowly. Day one deployment, as I told, is only 30%. All we need from you is, do you have a 4-year outlook minimum, right? Less than 3 to 4 years. I would advise you should not get into equity at this point in time in any fund house. Leave alone, I thought, any fund house you should not, given the market constraint. So have a 4-5-year outlook. If your return expectation is 13, 15% in solitaire or a little more higher in Vriddhi, you can consider. If you want low risk profile products within ithought universe, so we have 2 products, as you rightly said. One is Spear, which is our multi-asset, and one True Blue, which is our mega large cap fund, right? Only pure large cap, which is actually cheap today. So if you want only cheapest asset, either multi-cap, multi-asset, or our large cap fund will fit in. But I think you should take a 3 to 4-year outlook and don't be very tactical because market will not tell us when it will get bottom out and then rise again, right? Hope that answered your question, sir. If anyone is insightful, thanks. What do you mention? Hi, yes, ma'am. Yes, ma'am.
Yeah. So, Balaji, one more question, last one, is that 2 sectors, one is auto and one is banking. Banking, we have seen a lot of upside is also because of the interest rate cycle. and the cycle is expected to turn post May, post election, likely to see higher interest rates and all. So do you think the margin, what we have seen, elevated margins are likely to get compressed, and is it time to maybe exit or
In
maybe
banking,
allocate the capital out of it? That is question number one. Question number two, what about auto? Because auto has also seen a huge upswing, and then how does it look going forward?
I think banking is a very opposite view. The banking pain is well recognized today. I think if you have to take one sector which can capture India growth, right? As I told, India is today 325 lakh crore economy in next 1 year, going to go where 10,000 lakh crore economy next decade, right? One sector which can significantly capture the growth beautifully is banking, right? We have extremely good balance sheet in the banking. Corporate balance sheet is good. Retail balance sheet is okay, right? So it's a one proxy decision to play India is banking. I think we are very, very positive given the what to say the country investment cycle, right, which is actually in the uptick, right? And valuations are very, very attractive. If you look at any well-run bank, either they are close to the long-term average or they are 20% cheaper than the long-term average. I think this is not the time to take a call about seeing the temporary performance. Every segment, every sector goes through the temporary challenge. The challenge is well documented. One, as I told, deposit growth has been pretty slow. I think in next 12, 18 months that will come back. Margin compression, we are in the end stage of margin compression. I think that should stabilize. Luckily, credit cost is extremely benign, which is going to be the biggest driver. And growth of the economy is very good, right? So I think it is a beautiful sector to play, and we are very, very constructive on banking. Coming to auto, I think very interestingly, it is a mixed view. Yes, auto is come back very strongly. Few sectors are doing extremely well at this point in time. If you look at our portfolio, we were overweight on two-wheeler when nobody actually allocated a lot of capital, and two-wheeler has come back very strongly, right? And if you look at four-wheeler is also doing very well, and particularly in four-wheeler, higher-end vehicles are doing very well. And one view in the four-wheeler got category, the view got changed in the last 3 years is in 2020, the entire narration was only EV will drive the growth. But off late, with EV slightly slowing down, people are looking at both ICE engine, hybrid can well play a bigger role. That's where the market leader is a very interesting candidate in the medium term, and eventually it will be EV. If you look at commercial vehicle is slowing down, primarily due to last 3 years excess growth. So one is the base is very high, and second, some slowdown due to election. I think couple of contracts are getting delayed. Tractors is going through a slowdown during at this point in time. So it's a mixed segment. You have to be very specific, but auto is just come out of 2018 peaks. So I think we are in the early stage of auto. Definitely the easy money in auto has been done. I think from now on, it will be a very heavy lifting. Hope that answers our thoughts on auto and banking.
Perfect. Thank you so much.
Why does team likes insurance? What does change in recent time? Okay, I'm sure you will be seeing our portfolio. We love insurance for two reasons. One, if you look at our market today, extremely capital market activity is very high. So the froth or elevated earnings, right, which is not sustained today, we are able to see in a broking firm or a couple of asset management or some business which is highly linked with capital market. Our belief in the next 12 to 24 to 36 months is as things stabilize, the money will get rerouted to long-term savings product, which could be SIP, insurance, and so on and so forth. That's going to be very, very positive. That's point number one. Point number two, if you look at our penetration of insurance is subdued with economic activity growing, right? This is one category will be far more important from covering risk, primarily from general insurance. We are sub 1% of India's GDP in general insurance. Globally, if you were to look at general insurance, typically will be 3% of their GDP. So we are going to get two level of growth. One, India itself is going to get 10 to 11% over a long period of time. And you're going to see a sector which is going to go 1.5 times of India GDP, right? So it's going to be a very interesting sector from a very long-term growth. And we are very, very positive on general and life insurance. And third, the recent RBI move of clamping down on NBFC retail growth. If you think about them, they have to earn a fee income, which is not going to come from distribution of retail credit. They will be doing other products to support the fee income. And I think insurance is going to play a very, very important role for a lot of NBFC and fintech to support their business model. So I think it's a very interesting play. The stocks have not done anything well in the last 3 years. We see the risk to reward is very, very attractive. And that's why we are investing and we are stayed invested. And last 1-2 months, you can clearly see a couple of stocks have recovered very smartly when the market is actually stabilizing. What's a house view on hospital instead of pharma? I think hospital, we don't have any exposure. I think their stocks have done well, but it's a rent-seeking business, very high on capital. Most of them, if you have to look at the perception, right? When you go to hospital, I'm sure you'll be knowing we are getting charged high. I think government is paying a lot more attention. At this point in time, we don't find any ideas very rewarding. And maybe at future, if we find a good idea, given the industry low ROCE metric, at right valuation, we might consider. But currently, no idea is there in hospitals. Hope that answer your question, sir.
Balaji, one question.
Yes, sir.
So, sir, I just wanted to ask, like, as an outlook, we say India shining growth story. We also say there are pockets of, investment where it is possible to invest money, but still, as in across funds, all of your PMSs, we are sitting on cash, right?
Yes.
So
New
why is
account,
that?
right? New account, right?
New account, yeah. And we
Simple,
say
as I
that,
told, right? I agree. If you look at typically a 1 month account, will be like a 30, 40, 50% invested, correct? That's what, I don't know when did you come, sir, but I think we are taking a 4-year, 5-year outlook. And clearly in next 90 days, we are getting into an election. Market is frothy in points. We are waiting for last 1 year. There is not even a 10% correction happened in the market, right? So this is one relentless bull market happening. I think we are taking a medium term call. We want to wait out. We want to buy our stock at our price. Finally, we are taking the responsible call to deliver you the sustainable return in the medium term and not immediate. So for us, the easiest thing is to go and deploy today. With momentum, you will see a return for next 30 days, 90 days. But once the momentum falls, right, you will feel a lot of drawdowns in stocks. We are very, very careful, thoughtfully trying to build. That's why you see 30-40% deployment happening on day 1, day 2. And then every one opportunity coming in a particular stock, we are going to go and execute. So it
but
will
there is,
take 3 to 4
but
months for us. We
yeah, I
believe.
completely agree. But see, like how we also, because there's a dichotomy in statements which I'm feeling that, in FIIs, they miss the bull run, right? That's what we are saying. And that's why they're waiting to enter, right?
Correct.
And we don't know whether the corrections will come, not come, what will happen.
Stock specific will happen. No. I'll tell you one stock which we did not buy suddenly fell 20% and we are adding now, correct? I mean, it could be very stock specific action. For us, the desired IRR on a 4-year period, if the stock comes right, we will execute keeping a 4-year outlook. That's what I'm saying. I think in this cycle, we are very cognizant of what risk not to take. We are, after 4 years of a bull market, this deployment is happening. We want to be careful, but we are not at zero, right? We are not at zero and saying we will wait for one fine day. No, that's not. Every day we look into opportunity and say, is this opportunity at this point in time, can we make more return than less risk? And if we consider, we will go and execute. That's what you will be seeing at the portfolio level. I think this is a portfolio construction stage. We are no hurry to deploy on next 1 month very fast to say the world, we will match the markets. No, our job is to deliver sustainable value in the 3 to 4 year period. I think our decision making cycle is extremely ring fenced on that 4-year time frame. And given at this point in time in the market, economy is good, but definitely market is not cheap. This is not COVID bottoms, right? Where you can deploy day
Yeah,
one
no,
100%.
I agree. So, sorry,
what.
my being
No, no,
asking
no.
this again.
No,
So
no, no.
just,
You're right.
yeah.
You're
So,
right.
so when I see the PPT, I'm not able to wrap up everything in my head, right?
So I'll
The
tell you.
reason,
I'll tell you so. Economy is
1
in
minute,
good
sir.
shape.
Let me let me complete. The reason why I'm saying is, see, the PPT says that yes, India is in a growth trajectory. PPT says markets are not expensive because the PATs are improving, and that's the reason markets are not expensive. PPT says there are opportunities of growth in various segments, and of course, future is unknown. We don't know whether things will happen. But one broader economic outlook as of date is clear that India is a shining story, right?
Correct.
And then we say that we will be very stock specific. We are not able to enter. Yes, stock specific, there will be not much opportunity to enter, but there could be other stocks where you can, maybe maybe you enter, right? Because person who would have bought a stock 5 years back in your solitaire or Riddhi or any other payment, it's not necessary that he needs to own the stock 5 years down the line. For a new customer who would be ending a complete little different portfolio than the portfolio one which was 5 years back, right? So the whole thing of, growth, opportunities of space is there, but investing is on hold, is something which I am not able to wrap my head around.
I'll tell you. If you look at the last slide, right? Economy good, corporate good, valuation attractive in selective pockets, correct?
Yeah.
Exactly. Small cap, mid cap, there is a lot of froth. Look at last 3-year return. I'll tell you, there could be more than 200 stock out of 1,000 stocks has gone up 300, 400%. No company in India is growing at that rate. Stock prices have been distorted. Prices are going every day, right? We are in the midst of a very big bull market. I think you should see, we have been cognizant. I'm aware bullishness is there, but I think as a portfolio manager, our job is to protect you. Our job is to, that's why we are invested. No, we are not at zero. If we are at zero, I think I'm very, very clear. We are cautious, and next 90 days, we have the general election coming in. Let's say suddenly market falls 20% and we are able to deploy fully, right? We have set the stage for next 5 years for you, right? I think we are just seeing one particular stock can fall and we are prepared, right? So we have close to 100 company where we are very actively worked. We have a price range. And every day, if you look at last week also, slowly, my portfolio manager just shared me, he is in US and morning, he just shared me a data where a couple of names have fallen 30, 40% very slowly in the last 60 days. So we are watching very carefully. We are just waiting for you to take low risk. That is okay. By in names of taking low risk is where we are getting cognizant. Be patient. We will build a beautiful portfolio in next 90 to 120 days. And if one correction happens in next week, let's say, right, you will see so much action from us and we will finish it. We want to take low risk. That is our message.
Thanks, Balaji. I
hope
got
you
it.
appreciate us.
Yeah.
We will take low risk, sir.
Risk versus reward is what is
yes,
we
sir.
are protecting. Yeah,
I want to win a 5-year battle and not a 5-month battle. I think
sure.
I appreciate hope that
yeah, great.
That's
got it.
Thank you. We'll be sticking to a mandate that way. Okay. I think I've answered all the question in the chat.
Balaji, this is Venkatesh. Quick
yes,
question. What's your view on early mover? Is renewable sector still on the early mover stage? It's more out of curiosity. I do not worry whether you have it in my portfolio or not. Yeah.
We don't have big direct play. I think it's a very legitimate question. Definitely, if India is going to move from 325 lakh crores again to go back to 1,000 lakh crore economy, renewable energy is going to play a very pivotal role, larger role by mandate, by force. I was in Bombay last week, attended sustainability of a large conference of specialty chemicals. I met close to 30 MD. I think definitely the mood is how do I reduce my scope 1 emissions, scope 2, and definitely scope 3, which is a more complicated, I'm sure. A lot of our large investors know that, right? How your supply chain is reducing the either the power usage is from renewable. So it's a very interesting space. We are studying carefully, including nuclear. We think it's a renewable type, right? I think we are playing one of the stock in nuclear, did phenomenally well in last 3 years, very happy. But the point here is this is a very early stage. Lot of supply is coming. Balance sheets are yet to be clear. Business model is yet to be clear. Profit pool is not clearly determined. Who is a rightful winner is not known. So very early stage sector, high hype, execution is yet to be proven. But I think as the hype settles, like in every sector we saw, right? 2008 also infrastructure was the peak. And then we had a 10 years of no return period, right? So we want to let the hype cycle to come down. We are carefully reading, and at right point in time where we find a great company, where again, right, where you have a classic track record of profit pool, we will. What we will not do also, I'll tell you, sir, without any establishment of the industry structure or the profit pool or the business model, I thought as a philosophy, generally, we are not in for high risk, high return trades. We want to manage all our product with a slightly low risk. As I told, if we can deliver in solitaire, let's say for example, 15%, which is 3 to 4% more than the market, and take 30% lower risk, I think this is what our endeavor. But we are carefully studying. You will see us in right time, some opportunity where we will strike it. We are there definitely.
Okay. Thanks.
Sure, sir. Tarun, is there any other questions? Or that's it? Okay, sorry, I think I had few more. I think I missed out. It's there in the chat.
Yes, sir, in the chat.
Yeah. Sorry. Oh, I think chat has lot. Sorry, I missed it.
Balaji,
I guess aiming 12 to 15 is a bit conservative. I thought should aim for 15. I think different product serves different thing. As I told, we have delivered in solitaire 27% CAGR, sir. Having delivered 27, why did I say is in the long term, right? I'm talking about 5, 10, 15, 20 years, right? I hope we are all long-term investor coming for a very long-term return. India has delivered only 10 to 12. I think if we can deliver anywhere close to 15, I think it's a very, very happy outcome. But having said 15, we are not going to stop there. The proof of the pudding in the eating, and I'm sure you have seen our first shareholders are making anywhere made money in terms of close to above of 25. But I think 15, 20 in general is not a very sustainable one. For a very long period, if you see Buffett has delivered only 20 for 50-year period, right? So I think given the bull market, I think we see 20 is easy. India is only growing at 10%. So that's where our thoughts are. And will try to deliver with low risk. I think that's where the construct is. Solitaire is clearly planned for 15, not 12 to 15. I think True Blue and Spear is primarily planned for 12 to 15. Vriddhi will be definitely upward of 15. That's what our internal thinking, right? Close to 17, 18% types. There are instances of regulation in wealth management. We want one stock in the portfolio. Do share view on, please. I think regulation is good. Regulation is extremely good for larger companies. I think we own the largest of large, and I think we are very, very bullish, right? I think as long as our company manages the risk better and grow, these are business which also you need to appreciate doesn't need capital. So these are high free cash flow business growing at 20%, going to throw a lot of dividends to us, right? So we're very, very positive on the sector, but definitely we will be mindful on regulatory action if anything comes up. And if you have to see the name, it is not belongs to the same promoter, right? I think there is another company in NBFC got it. This is run by differently, completely professional. India's #1 wealth management, what we own in the portfolio. Thanks, sir. You like this one. What are the key risks over the medium term? The risk is simple. I think expectation of us should be close to 15% return. I think as long as from investor, if we have 15, we'll be very well served. Second, corrections do come. People think correction might not come. No, corrections will come when we don't think. With all the growth story, corrections can happen. I think 10, 20% equity correction and norm. I think these are the two things which we should keep in mind. If you have a 4 to 5 year outlook, I think definitely we'll be well served you. What about China? Hope the political sentiment does not impact industry. I think China, best of China times are done. I'm sure, but China is huge relevance, right? If you were to look at world GDP, which is $100 trillion, US is 30, China is close to 20. It clearly says they're very large, right? So they're very, very important from world growth. But I think for us, most of the growth for Indian company either comes from domestic demand or primarily from US and Europe and Japan demand, right? I think we are well served. Hope that country also does well, right? Because we don't want major collapse in any economy. That will create a lot of pressure at the global level, which is not conducive from an equity investing point of view. Very insightful. This is my first call. Enjoyed. Well, you deserve. Thanks, sir. Thanks. I think our endeavor is to keep tracking corporate India, which we do every day, but every 90 days as our honor to represent to our shareholders how we track, what's our perspective, so that we should build a very sustainable relationship over a long period and enjoy the fruits of India moving from a 3.5 trillion economy to a 10 trillion economy. What's your view on IT sector going forward? I think IT is a phenomenal sector, but a low growth. It typically end up growing 8 to 9%, but 100% free cash flow. So we like the sector for valuation. If valuations are not favorable, like currently today, we are not overexposed to IT. Coming to AI, these are very early days. There is a mixed view. AI can replace low-end work, but there is another view. AI can create a lot more demand for technology. So these are early days. We need to monitor it. One key metric is the people growth of IT will be measured to see how well it can impact in the medium term. But we have seen IT as a sector evolved multiple times, and it's a great sector from profit pool. If you can buy very cheap, it's a highly rewarding from even dividends. But near term, I think it's going to grow even slower only because of global growth is subdued. Hope that answer your question, Vimalan. Vignesh, given that we are having a bottom-up investing, how much importance you give to macro? See, I think even though we are bottom-up, macro do play a role, right? If you have to look at if the macro turns extremely headwind, both from growth, inflation, companies will struggle. And given the valuation today, macro will play a very important role. Why? The valuation reflects the growth, and the growth is coming out of macro support. So macro is contextual. Definitely, we don't only see macro and then take a full outlook. We are a bottom-up investor. But if I say macro doesn't have an influence on our company, on sales, profit, cash flow, dividend, I think that absolutely a no-no. Macro do influence. What we wish is, do our company has strategy? If macro turns slightly not favorable, still they can grow their top line by 10, 12%, grow the profit by 12 to 15, grow the free cash flow and pay better dividend, right? This is something we'll look for bottom up. From a macro, we see what India can give it to it, because the biggest driver of value comes from macro, right? So we do see it. If we deploy, say, 10% capital in the SPEAR portfolio next quarter, is there new idea to buy? Definitely, sir. We actively work with new idea. So if you look at our research process, we have close to 400 odd companies in the universe. We have 100 odd companies in our active pipeline, where being a head of research, we actively consider it. I think someone line is unmute. Sir, Madhusudan? Madhusudan, sir? Can you put your line on mute? Tarun, can you put the lines on mute so that...
Yes, sir.
Thanks. So I think we can definitely deploy. If you have capital, as I told in the beginning, have a capital of 4-5 years. I think we are well served. We have definitely ideas to deploy in all the funds and definitely in SPEAR. Thanks, very good, President. Thanks, hope you liked it. Thanks, very thankful, Mr. Balaji, wonderful, thank you. Why we are not having banking? Okay, that's a very strategic call. In the beginning itself, we have taken a call. Solitaire is one unique multi-cap in the country out of 1,000 odd or 100 odd multi-cap funds in the country. Solitaire is one fund where no banking, no NBFC. So it's a very unique fund. It's a cognizant call we have taken in the day one of the fund, and it will continue to be there. What we believe is India will give a lot more opportunity, and the investors are looking for a very differentiated portfolio. I think Solitaire is there to serve you well, and we are capturing the biggest part of financial wealth by having a lot of insurance, wealth management. So we are playing financial sector in a far more efficient manner, far more capital efficient businesses is captured in Solitaire. That's a positioning of the fund. But we like banking, but in Solitaire there will be no banks by structure. How does the organization protect the fund manager, increase the fund manager leaving the ithought? Okay, it's a good question, very strategic in nature. So if you have to look at organization structure, Shyam, who is a founder, CIO, fund manager in all the funds at the first level, then we have 4 fund managers, including me, my colleagues Rohit, Rajat, and Mr. Niranjan. Then we have a 6 analyst, 4 investment strategists, then execution team. So close to 19-member team. We have a very defined process in terms of the universe, as I told, the pipe and the selection, and finally into portfolio. So we have institutionalized in the last 4 years. Those who are aware have seen our team. Very happy to share to our shareholders. In the last 4 years, we have a 0 churn in our entire investment team, which clearly reflects we have the right structure in place to keep great assets for us is our people. and that's what the performance is also reflecting. So we are well protected, and you don't have to worry on it. I think we should stick to one question per person. Yes, sir. I think we will definitely. Who needs additional details, portfolio specific? Should I agree? Appreciate. Sorry, will not ask more. I think it's part and parcel. There are instances of regulatory action. I think I've answered it. I think the discussion is being dragged. Why can't people understand even high growth economy sector valuation is important? Okay. Come on, what about deployment of defense? Currently, we don't have any large exposure in defense. I think again, it's been driven by government and few policy makers. The policy is given by government. The buyer is government. The contracts are given by government company. It's a very important sector, but I think currently valuations are very, very not favorable. I think when price corrects and it stabilizes, we will see appropriately. Thanks, Lovely. How will investment strategy over next 5 years for Solitaire change? Do we churn in portfolio? Okay, the Solitaire strategy is very simple. Only two fulcrum principle. Deliver sustainable 3 to 4% more return than the market average, which is what I said. India, if India does 12, our aim to deliver 15, 16%. Deliver the return with low risk. So this is the primary thinking about Solitaire. And the way we want to manage is we will buy into very good quality of company where the risk to reward is very favorable, and we'll be very, very patient. I'm sure a lot of our investors who have spent 5 years, right, or 4 years clearly see our portfolio churn has come down dramatically. We are holding stocks for close to 4, 5 years. A lot of stocks have been, there is hardly any selling, right? So we will be a very patient investor. We want to compound capital in the medium term, and I think with taking low risk. So that's what the fulcrum, and we will not change anything dramatic. Hope that answered your question, Mr. Srikanth Venkatraman, sir. Thank you, thank you. Thanks for, hope you liked it. I think this meeting has gone for long. Tarun, hope we have answered all the questions, no, Tarun?
Yes, sir. We've ticked all the questions. Yes, sir.
Okay, thanks all for the end. I think thanks for your patient listening. We'll be happy to continue this Corporate India, which is one of our flagship scheme to communicate to our shareholders how India is doing, how Corporate India is doing, and the way we think and operate. Do join us every 90 days. We will put out to you. This was exclusive to our investors. So we thought we should first talk to you, share, take our learnings also forward. We'll be very happy to serve you in the long term. Thank you. Have a great weekend. Goodbye. Tarun, we can close the.
Yes, sir. Thank you, sir.